Welcome back to Financial Literacy for Lawyers, Bridging Law and Business. I'm Professor Seth C. Oranburg, and today's episode demystifies the cash flow statement. This is a document that lawyers might overlook, but arguably it's the most revealing financial tool for business risk analysis. We'll explore why cash flow matters, what red flags to look for in this crucial document, and how lawyers can turn knowledge into practical risk management. As we saw in episode 2, the cash flow statement is the behind the scenes footage of the money movement. It's cold, hard proof that checks the stories from the snapshot of the balance sheet and the movie of the income statement that we talked about in previous episodes. If you're piecing this together step by step, great job so far. We'll keep building your toolkit without overwhelming you. I just want to remind you that you don't need to be a numbers whiz. Just be open to see how cash reveals truth that other statements could hide. This is an educational podcast. For legal advice, consult a professional. The cash flow statement tracks the actual movement of money in and out of businesses over a period of time. Unlike the income statement, which can disguise problems behind non-cash items like depreciation, which are writing off asset costs over time, or through things like accruals, which are recording revenues and expenses when earned versus when they're incurred, not when they're paid. The cash flow statement answers a basic question. It says, is there enough real cash to pay the bills, to meet the obligations? Can we keep the business afloat? It's the ultimate truth teller, because cash can't be faked. It's either in the bank or it's not. So it provides a check against optimistic accounting. Cash flows are divided into 3 categories. Each tells a part of the story and offers insights into operation. The first category of cash flows is operating activities. Operating activities covers core business revenue and expense. So that's cash received from clients, cash paid to employees, cash paid to suppliers. It starts with net income from the income statement and adjusts for non-cash items like adding back depreciation since it didn't use cash. The second category of cash flows is investing activities. Investing activities includes purchase or sale of long-term assets like equipment, property, or future investments. Negative here might mean growth spending on future capacity. Positive investing activity could signal asset sales to stay afloat, perhaps liquidating to cover shortfalls. The third category of cash flows is financing activities. Financing activities covers borrowing debt, repaying debt, issuing stock, or paying dividends. Essentially, it's how the company funds itself externally, like taking loans or distributing profits to owners. Imagine a law firm. Operating cash might come from client fees minus office expenses. It shows if daily operations generate surplus. Investing activities could be buying new software to improve your efficiency. And financing would be like getting a bank loan so you could expand your offices. For lawyers bridging law and business, the breakdown isn't abstract. It reveals if a client can afford your fees, fund its growth, or survive market shifts without desperate measures. Profits don't always mean cash, and this is one of the big myths we have to bust. Profits can kind of be faked. For legal professionals, the cash flow statement is a risk detection tool. Companies can appear healthy on their income statement because they can show profits by making clever accounting choices. But they still might be teetering on the brink of insolvency, triggering all kinds of fiduciary obligations if cash flow is negative or if cash flow is erratic. Cash flow shows whether a company can fund ongoing operations and transactions, or if it's going to struggle to meet payroll, tax, or debt payments, or if it's masking problems like delayed collections. If it has slow-paying customers, excessive borrowing, or reliance on asset sales to stay alive, these are all red flags. Business challenges, such as breaches of contract for missed payments or partnership disputes over unpaid distributions, often begin with cash flow strain. Consider the 2023 Bed Bath & Beyond bankruptcy. Positive earnings on the income statement hid massive cash hemorrhaging from operations, with free cash flows of negative $320.5 million because costs exceeded revenues. This led to vendor disputes because they weren't getting paid, creditor battles because now they were triggering all sorts of loan covenants, and a fire sale of assets in order to try to stay afloat. The retailer filed for Chapter 11 bankruptcy in April 2023 after years of declining sales and inventory mismanagement, with directors facing scrutiny for ignoring the cash drain, which breached covenants and triggered defaults. In another angle, cash flow is central to fiduciary duties. When cash flow turns negative, boards must shift their focus to creditors because now they owe fiduciary duties to those external parties. And that was seen in recent Delaware cases where overlooked liquidity crisis led to personal liability. Simply put, profits can be engineered through choices like deferring expenses, but cash reveals a raw truth, and ignoring it invites risks for counsel who fail to flag it during due diligence or giving advice. So let's talk about some red flags and their business implications. You should watch for these critical indicators in the cash flow statement, as they often precede business headaches, and understanding them helps you advise preemptively. The first is negative operating cash flow. Repeated negative cash flow signals an unsustainable business model. No business can survive forever if it's bleeding cash, no matter what the net income claims. Think of it as living paycheck to paycheck, but if you miss a paycheck, you're forced to rely on loans or sales, and that's just not sustainable. The second red flag is reliance on financing for survival. And we can tell the federal government this too at some point, huh? Borrowing to cover basic expenses indicates a serious underlying problem, like a client funding operations with credit cards, and then every time they come due, just taking out another credit card and transferring the interest. This just increases leverage and default risk, and it's unsustainable. A third is delayed supplier or payroll payments. Chronic late payments, shown in rising accounts payable, reveals long time distress and could expose the business to disputes or regulatory scrutiny for unfair practices. The fourth is a mismatch with reported profits. If high net income doesn't generate cash, something's wrong. You have to dig deeper for aggressive accounting moves or maybe fraud, such as uncollectible revenues booked in order to meet some artificial target. The fifth is growth in accounts receivable without matching cash. The company may be booking sales it can't collect, which inflates the income statement while starving cash, potentially leading to future restatements and material misrepresentations. So these are just five clues that could trigger broad duties. The board might have to have obligations to lenders, and the company might actually be in default on some of its loan covenants. There could be all sorts of other compliance obligations that matter directly for counsel. For instance, in the Quadrant Structured Products vs. Verton case of 2014, persistent negative cash flow was key evidence that directors breached duties by not acting sooner, leading to a landmark Delaware ruling on oversight in insolvency. The case involved EBF and Associates continuing high-risk investments while insolvent, and the court emphasized that directors must maximize value for creditors in the zone of insolvency. So lawyers need to be able to tell when a company is in this zone because it changes the type of legal agreements a company can enter into. From a business standpoint, cash flow underpins several critical areas, making it indispensable for your practice as it directly influences outcomes in high-stakes scenarios. The first is solvency testing. Many insolvency provisions use a test that effectively asks, can the company pay its debts as they come due? This is a direct question about cash flow, not just net worth. So you need to look at more than the balance sheet to see if the company is truly solvent. And this is straight from the bankruptcy code, and it often decides if transfers are fraudulent. A fraudulent transfer can result in clawbacks if cash was insufficient at the time the deal was made. And so that leads us to fraudulent conveyance claims. Selling or transferring assets while unable to pay creditors is actionable. Cash flow proves the inability to pay element, supporting or defending against voidable transfers. The third is in due diligence. In mergers and acquisitions, buyers check cash flow to avoid inheriting a ticking time bomb. Poor operating cash might kill a deal or lead to post-closing disputes over misrepresentations. And the fourth is firm management, because for your own practice or advising firms, cash flow determines your operational stability, your capacity to grow, and your resilience in client payment cycles, especially when you're dealing with contingency fees where cash comes irregularly. In real terms, consider Hertz Global's 2020 troubles again. Despite restated earnings showing profits, negative cash flows from fleet investments and the pandemic led to a bankruptcy, a $16 million SEC penalty, and numerous investor suits. The company overstated income by $235 million from 2011 to 2013 through improper depreciation and reserve accounting, which forced a restatement that revealed unsustainable cash burns. The result was Chapter 11 bankruptcy filing in May 2022 amid COVID disruptions and, as I mentioned, serious legal consequences. So, what can you do to help your clients avoid these problems? Here are some actionable steps for you as a lawyer to integrate cash flow analysis into your work. And I'm going to try to unpack this for clarity. The first step is to review all three sections of the cash flow statement. And remember, we've got operating activity for core viability, investing activity for growth versus desperation, and financing activity for independence versus dependency on others. This all helps you see where the cash is coming from and going, and it tells you meaningful information about the health of the business. The second step is to track trends over multiple periods. Is cash flow improving, stable, or deteriorating? You can use a simple chart for visualization and to spot patterns, like seasonal dips that need buffering. The third step is to ask direct questions when reviewing statements. Why are clients slow to pay? Are there disputes? Are there some concerns about the product or the service? Are operating expenses rising faster than receipts? Does this indicate some inefficiency? Document responses for your own records to build a defensive trail. You know, even if it's your client, you might want to have something in writing as a CYA kind of email that you were doing your diligence. Because sometimes the client is doing things that are illegal and you have some obligations to suss it out. And the fourth step is to supplement cash flow analysis with review of the footnotes and management commentary. Those can reveal hidden short-term obligations or plans that will affect liquidity, like upcoming debt maturities. And the fifth step is to collaborate with forensic accountants for complex cases. It's not your job to handle all the problems, but to flag when it's time to bring in an expert. So if you build your fluency to ask the right questions up front, you won't be blindsided. In our next episode, we'll connect the dots across financial statements. We'll show how the snapshot, the movie, and the behind-the-scenes data together reveal deeper business risks, spot fraud, and allow for more effective compliance and client representation. Cash flow is the behind the scenes that doesn't lie. It bridges financial truth to better advising. And you're making great progress. You now understand the three fundamental financial statements in words that lawyers understand and how they relate to the risks that you deal with every day. Next, we're going to try to put it together. But until then, I'm Professor Seth C. Orenberg, and this has been Organized.